What's going on, Dividend Chasers? Dividend Bloodhound here with another investing episode. In this episode we're going to talk about 3 undervalued US stocks available for your Trading 212 app and the US stock exchanges, of course. We're going to quickly run through these 3 stocks and show you their fundamentals and how far undervalued they are and if they're a good buy or not. Hopefully this will bring you some value, enough for you to hit that like button in the corner there, or if you're brand new here, hit that subscribe button in the other corner there and ring that notification bell as well so you get notified when I release brand new content. That being said, let's actually get into the videos and let's have a look at the analysis, and the first company that we're going to look at is Honeywell. Let's get in there. What's going on, guys? Welcome to the analysis part of this video for our first stock, which is Honeywell. It is a absolutely huge technology and manufacturing company over in the USA, and it actually resides in the aerospace and defense sector. Though this company is so diverse, it makes products across a whole spectrum of industry and technology. Its ticker is HON. It has a market cap of $102 billion, a PE ratio of 16.87, revenue of $36.71 billion, an EPS of $8.62, and a nice dividend yield of 2.48%. It has a net income of $6.14 billion and a net profit margin of 16.73%, a profit margin of 16.73%, and a debt to assets ratio of 68.48%, which is creeping up a little bit, but not anything to be too concerned about, in my opinion. This company has been paying dividends for a very long time. Let's have a look at its growth rate at the moment. So its 3-year growth rate and its 5-year growth rate isn't spectacular. Obviously, as you can see, it is down slightly, but when you consider how much their revenue actually is and how long this company has been around, it's perhaps unsurprising that they have sort of plateaued in terms of their growth. However, they are still producing a lot of revenue and making an awful lot of money. As you can see there, the earnings per share growth has actually gone up 8.5 and 8.95% over the last 5 years, which is a very good sign. And the 5-year net profit margin is also up 8.58% as well. And for us dividend investors, the 3-year dividend growth has been 11.10%. And double-digit growth is absolutely brilliant in my eyes, in no matter which way it comes from. So, at the moment, it is on the market for a price of $145. You could have got it in the middle of the crisis down at $104, which would have been an absolute steal, and you'd have made a pretty healthy return on that already so far and boosted your dividend yield as well. Good thing to note about this company is it has not cut its dividend, so it's still paying and intends to carry on paying its dividend even throughout this crisis. And you could have got this company before the crisis at $189 a share, and there's no reason really to suggest that it won't eventually return to that price as well, giving you a significant $40 margin, give or take, in each share that you buy, which to me suggests that this company is well established. It's undervalued right now and should return to where it once was in the coming 6 to 12 months, giving you a really decent margin and a great dividend paying stock in the meantime as well. That being said, I'm going to leave it there, come out to the real world and introduce the next company. Catch you back out there. Hello again, guys, welcome back to the real world. So that was our company there, Honeywell, one of the industrial parts of this video that I've done in terms of my analysis. I'm going to move things on now. That one was quite a lower risk stock really. It's a very, very well established company, been paying its dividends for a long time and has weathered the storm quite well. Now we're going to move on to one that has not done quite so well, and that is Marriott International, big hotel and holiday chain, and for obvious reasons its share price is pretty battered right now. That being said, let's spin up and get in there and have a look at what you could actually potentially make on this one. What's going on again, guys? Welcome to the second part of this video and our look into Marriott International. As you can tell from the share price, it has been absolutely walloped by this crisis so far, and with obvious reason, because their revenue stream has all but dried up. Anyway, let's quickly have a look at some of their fundamentals pre-crisis and then actually have a look at where we're at after that. So ticker is MAR. They have a market cap currently of 29.08 billion, PE ratio of 21.73, revenue of 20.797 billion, EPS of 4.13, no dividend yield or dividend per se, because they're too busy reserving what cash they've got to keep themselves going right now. They had a net income of 1.27 billion and a profit margin of 6%, which isn't brilliant, but profit is profit at the end of the day. The biggest highlight of concern to me here is this debt to assets ratio of 97.19%, and anything approaching 100% or over 100% is obviously a massive no-no for most investors, and with good reason for that, because they don't want to get sunk with debt. However, until this crisis actually started up, they were in a better place than they obviously are now. So as you can see, the growth has been pretty good. Revenue growth has been pretty good over 3 and 5 years, double digits over 5 years. And they had a dividend growth before that, a 3-year dividend growth of 17.17%, which shows you how healthy they were and how happy they were to share that profit with their investors. Alas, not at the moment because of what is going on right now. Not many people will be using their hotels, so that is in turn going to affect their revenue and in turn also go on to their share price as well. And furloughing or sacking lots of their staff in the meantime isn't going to do great either. Anyway, looking back over the last 12 months before crisis, we can see that the price was at a nice $153 per share. Peak crisis, it fell to $62 a share, and not without good reason. Hit the resistance there and then has slowly sort of spiked back up and down a little bit, as obviously the market does. And then as people thought that we were going to come out of this a bit quicker than we did, it really did spike. And then when a second wave reared its ugly head and the possibility of it became even more likely, it dropped back down to 89. But there is that little spike there does show that there is the potential for people to garner interest back in this one. So there is a really decent margin in this one if you've got the bottle for it. However, that has to come with the acknowledgement of risk with this one, because this company really isn't making a lot of money right now, and the longer this crisis goes on, the worse off this company will be. But if you have got the bottle for it, it seems that they've got the money to get themselves through it. At least their hotels, so they're static, and they do have some maintenance charges, but it's not so bad as cruise ships or airlines, for example. However, this one is probably not one that I would go for personally too quickly, but it is one that I'm definitely keeping an eye on, and if it tumbles a bit more, I might consider getting in there, because the amount of money as a risky speculative stock, that amount of money to be made is pretty good in my opinion. That being said, I'm going to wrap this one up there and then I'm going to go back for a more stable long-term stock again. Catch you back out there. Hello again, guys, welcome back to the real world. There we go then, Marriott International, one of the more speculative stocks that are in our offering today, just purely based on the risk of how long this health crisis goes on for and when these hotels can start making any money again. However, there is a really good chance to potentially double your money on these stocks, and everybody is going to want to go on holiday eventually. It's just how much debt does Marriott International accumulate in the time that it takes them to actually get revenue streams flowing again properly, and that will be probably quite a staggered timescale, I would imagine, and it's not going to be a super quick V-shaped fix as we've seen and as us investors would particularly like. However, that being said, there is definitely money to be made in my opinion. Our next stock is Walgreen Boots, which is a heavy pharmaceutical big pharma company that has branches all over America and all over the world, distributing products and drugs everywhere it goes. It has got a huge revenue stream, a huge profit margin, and pays a really good juicy dividend yield for us dividend investors. That being said, let's get in there, let's have a look, and let's see how it actually shapes up. Catch you in there. What's going on again, guys? Welcome to the penultimate part of this video and our last stock of the day, which is Walgreen Boots. This is a huge big pharmaceutical company, as I've already mentioned, with retail pharma making up a significant chunk of their revenue, operating across the world essentially, as well as obviously the USA. Their ticker is WBA. They have a market cap of 38.71 billion, which is remarkably low considering their revenue is 136.87 billion. A PE ratio of 8.39, EPS of $5.26, a nice chunky dividend yield of 4.15%, and a net income of $4 billion. A net income of $4 billion and a profit margin of 2.9%. That is quite a slender profit margin, which is probably why the share price is how it is, as well as obvious health crisis. But that revenue stream surely will need some streamlining to get some extra profit. The debt to asset ratio is quite low, coming in at 65%, which is good. They can borrow extra money for this crisis if they need it. And they have a nice healthy growth rate in here of 3-year growth at 12% and 5-year growth at 5%, which is good for a company that is so well established these days. And then it has a 3-year dividend growth of nearly 7%, which is also excellent for us dividend investors, based on the fact that you're already starting with a 4% yield as well. This company is a big cash cow by the look of it, and is currently at a pretty good discount, I would say. So we have its current price is $44 a share. The slender profit margin coming into the tail end of 2019 and into 2020 has decreased the share price a little bit, as well as obviously you know what. So we're currently at $44 a share. Its lowest point was in May at $38 a share, and then the next point was a low crash in April as well. Oddly, it's not been too massively affected by the crisis, and the share price was on its way down as it was due to the slender profit margin, but they still are making $4 billion in profit, which is a significant amount of money, and still growing their dividend in the meantime. So over the next coming months, as the company seeks to make more profit from its ridiculous revenue and the health crisis tapers off, I think we could see the share price come back. I think upwards of $60 probably is a little too high, but we should certainly see more like 50 to 55 in my opinion. So there's definitely a margin in that one for you there, and you get the added reward of a significant dividend being paid every quarter for you, and one that's been raising year on year for at least the last 3 years, which is really good. And that wraps us up for the analysis part of this video of Walgreen Boots. I'll catch you back out in the real world. Hello again, guys, welcome back to the real world. Thank you so much for sticking around to the end of the video. Really appreciate it, really need the watch time right now. I'd also massively appreciate it if you haven't already that you hit the like button, get this video out to as many people as we can to help people get investing and have a look at some new stocks they may not necessarily have came across before. Please do your own research before you invest in anything as well. That sort of goes without saying, but I feel like I have to say that just in case. If you're brand new here, it'd be brilliant if you could hit the subscribe button and even ding that notification bell so you get notified when I release brand new content. That'd be great, and you can come and join me all over again and listen to the tone of my voice all over again. Yeah, that's pretty much it this time. I will catch you in the very next episode. It's been a pleasure to make this video and I hope you've enjoyed it too. I'll see you in the next episode. Goodbye.